Howdy, Team 42. It's your skipper here, Darius Dell, to present the August edition of our monthly macro scouting report. So, as always, we got a ton of information to get through in a short amount of time. So, let's just get right into it, starting with slide 3, our table of contents. So, we're going to, for those of you who are new, thank you and thank you for joining us. We're going to intro you to our 42 macro risk management process on slides 4 through 19. We'll dive into an overview of the portfolio construction summary on slides 20 to 22. We'll hit on our U.S. economic outlook on slides 20 to 23 to 28, our China economic outlook on slides 29 to 34, our Europe economic outlook on slides 35 to 40, and then we'll touch on all the key cyclical and secular forces that I think are most relevant for investors to have to handicap and risk manage today. That's on slides 41 through 92. And then we'll wrap up with the sort of deep dive on our portfolio construction in terms of the grid asset market backtest data that's feeding into that process on slides 95 through 122. We're not going to hit on all those slides. Most of them are denoted for the appendix, but we want to make sure we have all the data and all the transparency in there you need to help to manage macro risk over the next next few months or several quarters. And then lastly, we'll conclude also part of the appendix, our grid asset market backtest data, not just for the major asset markets, but also for each of the what we currently have as 20 ETFs in the current portfolio construction. So getting right into it on slide 4 here. Just introducing our 42 macro grid framework, which we use to measure and map bottom-up macro regime cycles. So for those of you who are new, when growth's accelerating on a trending basis and inflation's decelerating, that's what we call Goldilocks. When both growth and inflation are accelerating on a trending basis, that's what we call reflation. When economic growth is decelerating and inflation's accelerating, that's what we call inflation. And then lastly, when both growth and inflation are decelerating simultaneously, that's what we call deflation. On slide 5, the grids are global. So we run very sophisticated models to measure, map, and project what we call bottom-up macro regimes cycles for not only the U.S. economy, but for every major investable economy in the world. And so the key takeaway from this slide is that, we really are emerging from this sort of sea of green that is really born out of most economies in the world being in some form of reflation from the perspective of those bottom-up macro regime grids. Again, reflation is when growth and inflation are accelerating simultaneously. By the latter part of Q3 and certainly into Q4 of this year, it's very likely that most economies will be experiencing decelerating growth and decelerating inflation on a trending basis. That is new. That is definitely different than the bottom-up macro regime environment that we've been in for an extended period of time, as denoted by this table. So that obviously carries a whole host of different consequences for asset markets and investors to have to risk manage. And so that's what we're doing here. On slide 6, why grid works. We stand on the shoulders of giants here. Obviously, I'm a pretty intelligent guy, but I certainly didn't come up with the concept of regime segmentation or using growth and inflation as primary proxies and really principal components of asset class returns. Obviously, Ray Dalio is really the kind of the leader in that regard. Obviously, we tend to anchor on Danny Kahneman as it relates to extracting market signals from asset markets to project and the probable path forward, not only for the economy, but also for asset markets themselves, which tend to be reflexive. And then lastly, we really like to anchor on Professor Benoit Mandelbrot's work on the volatility space, because that is a key critical feature in all of our risk management tools. On slide 7, introducing the global macro risk matrix, which we use to measure and map the top-down market regime cycle. So there's 2 things I've already said that you should to take away. One, there's the bottom-up macro regime cycle, i.e., what are growth and inflation doing in trending rate of change terms in the economy? And then there's the top-down market regime, which is what are asset markets doing? How are asset markets behaving with respect to how they've historically behaved in each one of those 4 grids? So we use our global macro risk matrix, which is a dynamic factor model spanning across 42 different macro markets. These are the most liquid, most trafficked in, most widely followed macro markets in the world here. And what we're trying to do is identify, based on the behavior of each individual component of the model, in summing up those behaviors in aggregate, based on those behaviors, what regime is the market pricing in? And we're doing that by actually scoring each of the bearish or bullish signals as denoted by the red axis and the green check marks across each of those 4 grid regimes, based again on how each asset has historically behaved in the regime. So for example, Just looking at going from left to right here, MACE 1 is the MSCI Emerging Market Index. Right now, that's currently bearish from the perspective of our volatility adjusted momentum signal. More on that later. Right now, if it's bearish, well, historically, it's been bearish in inflation and deflation, the two risk off regimes in our framework. So right now, both inflation and deflation are getting a point from the MSCI Emerging Market Index, whereas Goldilocks and inflation are not receiving a point. We're doing that same process. We're iterating that same process across the columns of the table, but we're also iterating the same process across the rows as well, or up and down the rows as well. And we have this data going all the way back to the start of 1998. So the key takeaway for the next three slides, starting with slide 8, really sort of summarize how to think about that table, or they summarize all the data in that table in a much more cogent, easy to communicate, easy to interpret format. And so what I mentioned, okay, the points that the MSCI index were adding to both inflation and deflation, that same iterative process is being summarized here on the slide, where we see that currently right now, Goldilocks is being confirmed by 13 of those macro markets. Reflation is being confirmed by 7 of them. And inflation and deflation, again, both risk-off regimes in our framework, are being confirmed by 16 apiece. So that's pretty meaningful. That's definitely a market shift from where we have been for really the balance of a really, really extended period of time, since going back to the early part of the second quarter of last year. Since then, both growth or Goldilocks and inflation have been battling for dominant market regime status, which we'll touch on in a couple slides. But now we've obviously seen inflation and deflation take the modal outcome title from the perspective of the scoring process. So that's new, and that's something we want investors to really anchor on and really focus on. Okay, how is this nascent signal likely to evolve? Is it a head fake, or is it something that's likely to start to trend based on the bottom up macro regime cycle, but also based on the changing dynamics with respect to monetary and fiscal policy? On slide 9, looking at the market regime probabilities as a function of that scoring process. So each of those scores, the share of each grid score, the share of each grid score as it relates to the total confirming asset market VAMs, i.e. the black line in the previous chart on slide 8, that's currently at 52, which is roughly a 40th percentile reading for that historical time series, again, going back to 1998. So each grid regime share of that number, that total confirming asset markets VAMs number, is said to be its probability. And so the regime with the modal outcome from a probability perspective is what we call our dominant market regime. So right now, both inflation and deflation are tied atop this scoring system from the perspective of dominant market regime. Again, as you can see by the chart on the right, this is a new development and something where we obviously are monitoring very closely, because again, either of those grid regimes will sort of tell you that investors should be taking less risk in asset markets, having more cash, being more defensive with respect to their sector and style factor pivots in the equity and credit market. So again, this is obviously something that investors are, getting. It's a signal that investors are getting nervous about the forward outlook for the economy, the forward outlook for monetary support, more forward outlook for fiscal policy support as well. So again, it's new. It's something we're watching on a daily basis. We're watching it evolve, and we're definitely going to continue to monitor that. On slide 10, looking at the dominant market regime. So as I mentioned, the market regime, the grid regime, with the modal outcome distinction from a probability perspective, is what we call our dominant market regime. And the reason that distinction is extremely important from the perspective of our macro risk management processes is because we orient our macro risk management according to the dominant market regime. So, i.e., if we're in deflation, we want to be buying things that agree with deflation, and we want to be selling things that disagree with deflation. In so much that if we go back to Goldilocks, or if we go back to reflation, we want to be buying things at the margin that agree with that view, as opposed to and selling things at the margin that disagree with that view. This is a very important chart. This is a very important part of the process, because again, we always want to be orienting ourselves according to the dominant market regime. Think about the dominant market regime the same way you think about the weather. If it's snowing outside, you're not going to walk outside wearing tank top, shorts, and flip-flops. And if it's bright and sunny and a hot, sunny summer day, you're not going to walk outside with a parka and boots on. This is exactly how we think about managing macro risk as well. This is our way of quantitatively assessing the weather at any given moment in and across asset markets. Slide 11. Our global macro risk matrix is excellent at signaling risk-off market conditions ahead of major drawdowns in risk assets. So the dotted blue lines and red lines in this chart show when our global macro risk matrix process transition to either deflation, blue, or inflation, red. Again, both risk-off regimes ahead of material drawdowns in the stock market. And this is going back to, again, since the data beginning in 1998. We can pull it back further than that, but I'm trying to keep my computer alive. Anyway, so again, as you can see, the our global macro risk matrix on an out of sample basis has transitioned to inflation or deflation just ahead of some all of the meaningful drawdowns that we've seen in risk assets since going back to, again, 1998. So we have a lot of confidence in this system of doing what it's designed to do, which is to help you, one, save money and avoid major drawdowns, and then two, compound returns by being invested in the securities, the assets, and the exposures that, again, agree with the weather, i.e. the dominant market regime. In slide 12, I mentioned our volatility adjusted momentum signal, again, when we spoke about the global macro risk matrix on slide 7. And again, what that model is designed to do is identify confirmation in medium-term price momentum born out of the change in the volatility regime, the evolution, rather, of the volatility regime. What we're looking for is for assets that are inversely correlated to volatility, if it has positive medium-term price momentum and volatility is in the part of the distribution that is historically perpetuated lower drawdown risk. So if it's for something like a stock market, the VIX is in the lower median of its distribution, whereas something like Bitcoin, which is historically positively correlated to its own volatility, that be in the upper median of its distribution. So that's what we're looking for. As you can see here, the S&P 500, it's bullish. The crude oil is actually still bullish, although I would argue that it's likely to transition to at least a very neutral state if we see a continuation, if we don't see a meaningful and quick recovery in this chart over the next few days. In slide 13, looking at the Bloomberg Dollar Index and the 10-year tips break even. The dollar index is neutral. It's been maddeningly neutral really since the middle part of the first quarter of this year. It has really found it difficult to break below 1100 on the BBDXY. That's the Bloomberg Dollar Index, which I find to be the most thoughtfully constructed dollar index basket for a variety of reasons, but that's neither here nor there for this discussion. But again, it's also found it very difficult to break out above 1150 as well. So it's kind of been trapped in this range, and clearly the next shoe to drop with respect to monetary and fiscal policy is likely to break it out of that range. And again, I think that there's a lot of discussion on what that next shoe to drop is and when it might be, because again, we have some pretty meaningful catalysts coming down the pike as it relates to the budget resolution, the debt ceiling, the potential announcement of a tapering program. Obviously, we got some important economic data we have to observe between now and receiving all those policy catalysts. So the dollar has been maddeningly neutral, and is maddeningly neutral for a reason. But one thing that's not neutral is the 10-year break even, which has been bearish VAMs since it broke down to bearish VAMs in the early part of June. On slide 14, looking at the 10-year Treasury yield, that remains bearish. It's obviously had a bounce as it relates to the recent jobs report and a little bit of follow through on Monday, but the reality is, as long as it remains bearish VAMs, the path of least resistance is to the downside. So unless we have unless you can tell me that the economy is about to go back to reflation, which again is the only grid regime that you've historically seen an acceleration or price appreciation in the 10-year yield, price depreciation in the actual 10-year bond. The bonds and yields are inversely correlated or inverse to each other. That's really the only grid regime from a bottom-up economic standpoint where you should expect a trending rise in long end interest rates. So if we're not headed there, I'm not going to have a lot of confidence. Again, our model just suggests we're not likely to be headed there. Therefore, we don't have a lot of confidence that we're going to see a meaningful breakout in the 10-year here. Again, it could bounce and climb along its upper boundary of its probable range, which is the charts on the bottom of these charts. But however, again, we'd be hard pressed to see a material breakout from here in the context of our bottom-up macro regime forecast. And then lastly, on slide 14 here, high yield OAS, that's narrowly bullish. Again, the signal line there is about 333 basis points wide. As you can see, we're very narrowly above that in terms of last price, but also in terms of its local price regime, which obviously last price is part of that calculation. This is something you would expect to see in a inflation or deflation, in a debate between inflation and deflation for dominant market regime status. Ultimately, we do believe that debate could potentially be resolved in a positive manner with the move back towards Goldilocks, but the likelihood of that occurring definitely was diminished upon Friday's July jobs report, but more importantly, it could actually be completely diminished upon the advent of Wednesday CPI, which we expect to decelerate, but to the extent we see a material positive shock to the upside, surprise to the upside rather, I think all bets are off in terms of anticipating a return to more Goldilocks like market conditions, which is what we really observed throughout June and really the early part of July. Slide 15. So looking at, sort of sector and style factor, or mostly style factors, because style factors tend to be the most consistent things across the grid regimes over time. So obviously what we're trying to do from a regime segmentation perspective is identify states in the economy using, two very important principal components of asset class returns to identify, sort of states in the economy where you see limited dispersion across the regimes, but also limited dispersion within regimes from the perspective of sector and style factor leadership. Sorry, did I say limited dispersion across regimes? Now you want maximum dispersion across regimes, i.e. you want the regimes to look differently from the perspective of how you're characterizing the economy as it relates to asset markets, but you want limited dispersion within the regimes. High dispersion across regimes, limited dispersion within regimes. That's how you know your regime segmentation process is actually onto something and doing what it's supposed to do, as opposed to just being noise. There's a lot of noise out there, obviously, in terms of what we do. So getting back to the charts here on slide 15, high beta, low beta ratio, that's bearish VAMs, very recently bearish VAMs. It's overbought here, so it suggested that a lot of the upside surprise that filtered into asset markets from Friday's jobs report might be a little bit long in the tooth here. Small cap, mega cap ratio, that's bearish VAMs as well. So again, both of the states of these ratios are confirming a move towards inflation or deflation from the perspective of the dominant market regime. Right now, we would argue it's currently deflation, or we give the nod to deflation just based on our bottom-up macro regime forecast, which we'll touch on in a little bit. On slide 16, the value to growth ratio, that's bearish VAMs, so confirming the same sort of risk off tilt, not necessarily fully risk off yet, but certainly directionally risk off from where we had been earlier in the year. But the one thing I will say on that is the VIX ratio, which tends to break down in advance and then obviously through meaningful declines in the stock market, that ratio is still bullish. So telling you to keep risk on, but don't necessarily be, overloaded to the gills in terms of the cyclical sectors and style factors that investors really got paid to bet on as a function of the economy being in reflation, growth and inflation accelerating on the trailing basis for an extended period of time. On slide 17, some of the ancillary tools in the toolkit that give us a lot of confidence, on days, particularly on days where you're seeing big moves in markets, big newsy days with perspective of economic catalysts, things like that. We look at crowding through the lens of the relationship between implied volatility on a 30-day forward at the money put basis relative to our calculation of the local realized volatility regime, which is just the mean of the 10-day, 20-day, and 30-day realized volatility. So in terms of looking at this chart, you're seeing a lot of wall of worry out there in terms of investors really bidding up elevated implied volatility premium into a lot of risk assets. In fact, you're actually seeing you're seeing some crowding into shorts as well. You're seeing implied vol premium being built into things like junk, IWM, which is small caps, IWN, which is small cap value, things like that, crude oil, obviously. You're seeing implied vol premium built into things that have already corrected. And so this is indicative of investor consensus that's probably not leaning over on its ski tips from a gross exposure perspective. When you look at dispersion, they're certainly not leaning over their ski tips from a net exposure perspective, because for the last nearly 2 months, you've seen defensive sectors and style factors, sort of dominate the upper quintile of this performance. We're showing here in the blue bars is the month-on-month Sharpe ratio, and this is across 50 U.S. equity sectors and style factors and mega cap FANG type exposures. And so the fact that it's been dominated by defense for such a long time is really indicative of the fact that investors have really taken off a lot of risk from a net exposure perspective. On slide 18, so the systematic tracking of crowding and dispersion helps Team 42 identify what grid regime investor consensus is rotating into in real time. And this is something we've caught on in our recent notes and in our recent publications, is that, hey, it looks like the market investor consensus is either being forced by the, sort of the risk management systems at the sort of quote unquote pod shops. They're either being forced into putting on deflation, or they're fundamentally agreeing with our outlook. I think it's a combination of both. But the reality is, for the last 2 months, underneath the surface, the equity market is clearly and cogently bet on deflation from a bottom-up macro regime perspective. So that's in line with our forecast. So we don't expect it to change on a material way, but certainly you can get a 1 to 2 week head fake if you get the wrong inflation print and you get some fall through from what we saw on Friday and Monday from in terms of the labor market report. On slide 19, positioning is kind of sending the same dynamic, or sending the same message rather. When you look at, so there's 36 market indicators in this table, and this is the CFTC net speculative futures and options positioning. We like to look at it on a 3-year Z-score because that tends to back test the best as it relates to projecting for returns. And then, so, when you look at this table, there's 36 market indicators in the table, 26 of them what we call risk assets. The mean 3-year Z-score in terms of the net speculative length in those markets is only 0.2 at the current juncture. So again, another quantitative way to get to the same conclusion that, hey, the buy side's not taking a ton of risk here. And something we'll talk about later is there's a lot of cash on the sidelines as well. So it's hard to see a market that's ready to really crash, but it's certainly, you can observe a market, and we're quantitatively observing a market through the lens of our global macro risk matrix of a market that is certainly on edge, and it won't take much to push it over the edge. And that's what we're observing, and that's what our system is signaling. It's not quite ready to go over the edge, and we're cognizant of looking for the catalyst that might actually tip it over the edge, because we're being told by the weatherman that, hey, it's actually kind of raining now. It's no longer bright and sunny out. So jumping into the portfolio construction process. So this is our dynamic asset allocation framework. Again, these aren't just colorful pie charts. They're born out of the relative performance of asset classes. We think about equities, commodities, fixed income, and FX in those regimes. So these are if you did nothing but buy SPY, DBC, TLT, and UUP, these are the relative relationships you'd have with those things in the context of those back tests. But obviously we want to be a lot more thoughtful than that. That's how you earn your fees, particularly for professional investors. And so we look at on slide 21, we have a thoughtful, carefully constructed portfolio construction process that is designed to help guide investors into the next macro regime, into the next market regime cycle. So we use our bottom-up macro regime forecast, i.e. what is the economy doing, to help us anticipate how the top-down market regime is likely to evolve, particularly in and around phase transitions. On average, there's about 2.5 material phase transitions in the dominant market regime per year. And what I classify as material as market regime phase transitions that go from either Goldilocks or reflation to inflation or deflation, or vice versa. Because going from risk on to risk off is how people get hurt, and going from risk on, and so much that going from risk off to risk on is how people get hurt, because a lot of investors tend to stay way too short for way too long on the short side, and they get their faces ripped off as asset markets recover. So this entire process is designed to help investors not get their faces ripped off on the short side after a correction, and also not get blown up into the correction as a function of sort of not seeing it coming. So that's sort of how we think about managing macro risk in and across cycles here at 42 Macro. On slide 22, so this is our current portfolio construction. We have this sort of hybrid deflation Goldilocks portfolio on as a function of, again, we expect this inflation deflation debate to resolve itself positively, mostly as a function of our views on the economy, and particularly on inflation. We think inflation is likely to be decelerating on a trending basis from starting in July all the way through the middle of next year. And so if we're right on that view, it's very likely that the Fed can actually sort of take a more measured pace in terms of announcing tapering, sort of actually implementing tapering and things of that nature. Now, again, I would argue the July jobs report certainly threw a wrench in that discussion, and it made it less likely that deflation returns as the dominant market regime. But again, it's still outside. It's still a likelihood. There's still a legitimate risk of that occurring, and so we certainly want to be positioned for that, particularly. So just kind of going down the list, we got defense, mega cap growth, size, real estate, healthcare, Ireland, Ethereum, Eurozone, quality, low beta, crude oil, and financials. Crude oil sucked the last couple of weeks, but again, in so much as financials are great. Sometimes this is why you have thoughtfully, carefully constructed portfolios that are balanced, so we're not over our ski tips and actually getting tagged by something that we shouldn't be. Something like crude oil and obviously gold down there this week. In terms of our fixed income and FX exposures, we got ag, EDV, EMB, emerging market debt, gold, LQDs, IG credit, tips, 20-year treasuries, and then the US dollar. And then we got about 20% sitting in cash. If you combine the 12% we have remaining to be allocated in Goldilocks and the 8% remaining to be allocated in deflation. Not at all in a hurry to allocate that cash at all. If anything, our in terms of how Wednesday CPI report could actually be, in terms of how that report is presented and the data they're in, we could actually be raising incremental cash from there. Because again, I do believe the path of least resistance on a hawkish inflation print is to the downside for risk assets, because it's definitely pulling forward the pace and timing. It's pulling forward the timing of the tapering, but it also might actually amplify the pace of tapering, or at the bare minimum, amplify the market expectation for the pace of tapering, which to me is the real key takeaway. It's not about what actually happens, it's about what the market thinks is going to happen and how that's going to evolve. On slide 23, getting into our grid outlook. So this is the US grid outlook. So we're obviously transitioning again from a long sequence of reflation to a extended sequence of deflation in terms of the US economy. That's likely to commence in September. On slide 24, this is just showing the US the growth plot from a secular and cyclical perspective. Not going to see anything that scares you in terms of the delta, in terms of the speed of the deceleration. And in terms of the grid asset market backtest, in fact, we'll talk about this a little bit later, but that speed of the deceleration, i.e. being a 0 sigma delta on the growth decel, that's nothing to be concerned about from the perspective of asset markets. Again, we think the monetary and fiscal policy dynamics that we're likely to observe in Q3 and Q4 are much more onerous from the perspective of asset markets and the deceleration in the economy. On slide 25, just kind of showing all the line items in our US growth agent-based nowcast model. As you can see, April was the peak. We're starting to decelerate. And when does that trend really start to take hold, that trending deceleration? Again, we think September will be the month where the investor consensus is broadly aware of that trend lower. On slide 26, getting into our US inflation view. So the chart on the left is the secular view. The chart on the right is the cyclical view. Obviously, we have inflation projected to roll over in July and decelerate really through the middle of next year. However, at some point in Q3 of next year, it's very likely that inflation bottoms and starts to reaccelerate. And that'll be, in my opinion, be a big, meaningful catalyst for asset markets, because that'll be when investors realize the stationary mean of this headline CPI time series, and really most inflation time series here in the US, has likely transposed itself higher. That's a big deal. It's not a big deal today, but it certainly will be a big deal in our opinion, starting in the middle of next year. On slide 27, this is our inflation agent-based nowcast model. So all the dynamics in the inflation model that are moving in terms of, we're finally starting to see some win out of the sales in terms of commodities and prices paid indices here in July. So hopefully not hopefully, we don't do hope here, we do math. So it's our expectation based on how all those things are feeding into the model that we do see a deceleration in tomorrow's inflation print, but we might not, who knows? We're prepared to react however it may be. In terms of the US valuation overlay on slide 28. So the one thing I'd call out on this chart is that US equities are a bit rich relative to their international counterparts. That first row there shows the next 12-month PE ratio spread on a 1-year PE ratio spread relative to the MSCI MSCI All Country World Index, its PE ratio. And we're showing that spread and showing the 1-year Z score of that spread. And obviously we're 1.6. So a little bit rich relative to global equities, but nothing really to cry about or write home about. On slide 29, looking at our China grid outlook. So slowing growth is likely to start to accelerate to the downside, as you can see in terms of the July, August, September dots on this grid model, or on this grid chart here. So that's something to keep in mind. Obviously, PBOCs really started to respond to that in terms of monetary easing terms, but they certainly have not put out the bazookas yet, like we saw them do in 2008, 2009. We saw them do in 2011, 2012. They put out the bazooka in 2015, early part of 16, and then obviously they put out the bazooka last year. We certainly have not seen the bazooka, but certainly we might actually start to get it once the PBOC and the Hewlett Bureau are really observing some of this acceleration to the downside that we have projected here for the second part of Q3, or for the second half of the third quarter. Sorry, mouthful. On slide 30, looking at China growth from a cyclical and secular perspective, similar thing. China's really starting to inflect and accelerate to the downside here. On slide 31, you're actually already kind of seeing this in the high frequency data. Now, again, we're using this OECD composite leading index data to project the growth, to measure, map, and project the growth dynamics in every economy that we model. And part of the reason we anchor on that data as opposed to GDP is because it's monthly. It gives us an opportunity to not only project monthly spot inflections in the economy on a monthly basis, but it also gives us opportunity to project those inflections on a monthly basis to give us a little bit better timing, or a lot of it better timing relative to the lagging GDP report, respect to timing those market regime phase transitions. They don't always come on the first of the quarter or the last day of the quarter. No, the managing macro risk is messy, but we're trying to do our best to amalgamate all of the data and economic and financial market signals into a very clear, cogent, systematic process that allows you to sort of, proactively front run changes in the broader market regime. On slide 32, looking at China inflation from a secular and cyclical perspective. So still some upside over the intermediate term with respect to Chinese inflation. So that's something that may handcuff the PBOC, but again, we don't anticipate it will. It's certainly not going to accelerate, at least according to our models, to a level that would actually put the brakes, cause them to pump the brakes on their newfound easing drive. On slide 33, looking at the China agent-based nowcast model. So one thing I call out here is that you're actually still seeing an acceleration in PPI, particularly for manufacturing PPI, things like that. So that to me is telling you that there's still a decent amount of inflation in the system. That's supportive of our grid models view of the chart, of the previous chart, that in China, inflation in China is likely to trend higher from here. On slide 34, looking at our China valuation overlay. The one thing I would call out is that Chinese bonds, which is the third row, looking at the 10-year yield spread for the Chinese 10-year relative to the Barclays Global Ag Yield to Worst on a 1-year Z-score basis, that's showing you that the 10-year Chinese 10 years is quite narrow relative to the Barclays Global Ag. So that's something to call out. Again, we don't start with valuation, we end with valuation here at 42 macro. Valuation is not a catalyst. What's the catalyst is the rate of change of growth, the rate of change of inflation, and the change in the evolving policy dynamics with both respect to monetary and fiscal policy. And then you layer on valuation, identify, hey, if this is actually cheap or expensive and it agrees with all those things, that's when you have a real best idea, big position type exposure from the perspective of our process. On slide 35, looking at the Eurozone grid outlook. So it's a classic clockwise grid sequence, GRID. Just going around the clock, and this is exactly what you would expect to see if you don't have interventionist monetary and fiscal policy in your economy. Obviously, Europe certainly had a decent amount of interventionist monetary policy, but its fiscal policy response has been well shy of what we observed, obviously, here in this side of the pond. On slide 36, looking at Eurozone growth from a secular and cyclical perspective. One thing I would call out is that we have our models as Eurozone growth accelerating for longer than both China and America, but also not decelerating as fast as well. So we, ironically, you rarely get to say this, but the European growth outlook is very marginally better than what we're observing here in the US, both in terms of the reported data that we're observing, but also in terms of the projections as well. Again, not a material difference, but it's a very rare, economic outperformance in Europe relative to the U.S. And part of the U.S. is that we just have this hangover, from the sugar rush of fiscal stimulus, not only late last year, but also late in Q1. And that's something that's dragging on growth now in terms of the payback. On slide 37, Eurozone growth, our agent-based nowcast model. You see, again, unlike the U.S. Agent-based nowcast model, which again was on slide 25, the Europe nowcast model is still showing deepening green as you get into June and July. Our deep green peaked in April. Theirs is now starting to peak. Theirs is still continuing to accelerate. So you're definitely observing that as well. And again, obviously green is good, red is bad from a levels perspective. Slide 38, looking at European inflation from a secular and cyclical perspective. So our model has inflation in Europe, marginally ticking higher, not necessarily marginally ticking higher, ticking higher through, I want to say, September, October of this year, and then peaking and rolling from that point forward. This is something, I don't think it's going to catalyze a material shift in monetary policy provision and guidance out of the ECB, but it's certainly something that obviously would, it makes the likelihood that it certainly makes the likelihood that German bonds are a little bit hawkish and things like that it increases the likelihood that's on slide 39, looking at our Eurozone and inflation agent-based nowcast model. So again, you're still seeing inflation pressure build in Europe. You're seeing it build in Europe. You're starting to tick down in the US, but you're actually still seeing it build in Europe and China. So that's something to call out. on slide 40. And then lastly, looking at Eurozone valuation overlay. Nothing too exciting to call out. I would say European financials are cheap on a relative basis to the index, but I mean, how many, like, write me a check for, how many times have you heard European financials are cheap in the last decade? I mean, again, I don't want to be the next guy who says that, just what the data is saying. But again, as we don't start with valuation, they're really just supportive, tangents to what we're really trying to do here, which is forecast the rate of change, cycle, and growth and inflation, and ultimately predict how asset markets are likely to respond to those cycles, and also how policymakers are likely to respond to the cycles as well. So getting into what you all came here for, which is the meat of the deck, which is a key cyclical and secular forces that we see, really impacting the economy, really impacting asset markets over the intermediate to long term. So one of the four main long-term forces that we care about here at 42 Macro is demographics. There's four forces. There's demographics, there's leverage, there's politics, and there's balance of payments. We'll talk about each of those four in the context of some of the evolving dynamics in the U.S. and global economies, starting with demographics. So demographics, one thing that hasn't changed is they're still disinflationary across the developed world, and how we look at that is the 5-year forward old age dependency ratio relative to the working age population, that 5-year forward CAGR. This hasn't changed. On slide 42, the secular drivers of U.S. disinflation are still largely intact. What we're showing here is the blue line is the labor force participation rate, red line is the velocity of money, and the black line is the imports as a percent of GDP for the U.S. economy. Still, none of this stuff has changed. On slide 43, corporate America continues to be dominated by monopsonies and a broad-based preference for capital expenditures over labor. Well, you look at, the red line or the blue line is showing the sort of the market cap of the S&P 100 index as a ratio to the market cap of the S&P 100 index as a proxy for monopsony dominance in the U.S. economy. And then the red line shows the compensation of employees as a percent of the consumption of the fixed capital. And as you can see, that thing is just on its lows, and it's been a multi-decade process of getting to those lows. They've obviously bottomed, but again, the quote unquote bottom in the 80s and 90s as well. But certainly made new lows since then with the advent of globalization and China joining the WTO, private equity, things of that nature, and obviously just the onset of the digital economy. Obviously, we've had some pretty material technological developments in the last 20 years as well. But both of those are disinflationary. So the last two charts are telling you that a lot of the disinflation pressure that we've observed hasn't gone anywhere, which tells you that some of the high inflation prints that we're observing likely could dissipate in line with our forecast. On slide 44, cyclically speaking, however, we have not yet observed firm evidence of peaking domestic price pressures. This is headline CPI on a seasonally adjusted basis, the blue, the shaded area at the top. The key takeaway from this chart is that, headline CPI is growing at an 11% annualized rate. So that's obviously accelerating to the upside on a year-over-year rate of change basis as well. So have not observed, peaking price pressures, at least on a headline CPI basis. On slide 45, core CPI momentum remains elevated as well. Still up 11% on an annualized basis. Again, still accelerating on a year-over-year basis as well. On slide 46, the key drivers of inflation at present do appear to be driven by temporary supply-demand imbalances rather than something more permanent. So we're showing used cars here. They're up on they're up 231% on an annualized basis. That's obviously not going to stay there. That's going to come down. It's really about the rate of which it comes down. That's going to be most impactful for asset markets and most instructive for policymakers. On slide 47, same thing. Key drivers of inflation, they look like they're being driven by temporary supply-demand imbalances rather than something more permanent. Looking at hotel inflation, up 149% on an annualized basis. Again, definitely coming down from that number. It's really just about the pace with which we come down from that number. On slide 48, looking at airfares, those are up 38% on an annualized basis and have already come down. They peaked in April and they've come down a decent amount over the last couple of months. On slide 49, looking at dining out. So again, still accelerating obviously on a year-over-year basis and on a month-on-month annualized basis as well. That latter number is 8% on a month-on-month annualized basis. So again, a lot of the stuff that's driving inflation right now is all stuff that's really just associated with, supply-demand imbalances associated with reopening. A lot of you can envision an economy with a lot more labor supply once we roll off the enhanced federal unemployment insurance, and once more people get vaccinated. If they're not scared to death by Delta, they'll scare them. The media will scare them to death with Lambda. If the Lambda doesn't do it, they're going to go to Zeta and Theta and so on and so forth. They're going to try to keep this COVID fear-mongering narrative alive as long to get everyone vaccinated. And so as more and more people get vaccinated, a lot of these supply demand imbalances will start to ameliorate themselves in a way that's positive for that's sort of supportive for our disinflation projections. On slide 50, when you look at less volatile measures of inflation, they're actually showing signs of slowing down. And so you look at this as the core PCE on a seasonally adjusted basis, and obviously still accelerating on a year-over-year basis. But when you look at it on a month-on-month annualized basis, up 5.5%, that's actually ticking down. And so you're seeing, this is sort of in line with our view. Okay, we still have a lot of disinflationary pressure in the economy. A lot of the inflation that we're seeing right now is really being driven by, again, temporary supply demand imbalances. On slide 51, median CPI hasn't materially budged from its post-crisis trend of 1.5 to 2.5% annualized inflation. We're a little bit above that at 2.91% currently in terms of the annualized rate. But again, nothing to write home about in terms of a sea change like what we're observing in things like used cars, airfare, hotels, and autos and stuff like that, and dining out. On slide 52, trimmed mean PCE inflation remains structurally depressed, which does lend credence to our transitory view. So we're looking at the Dallas Fed as the trim mean measures for 1 month annualized PCE, headline PCE inflation, 6 month annualized, and then 1 year over year. And we're somewhere between 2 to 2.3% for each of those metrics. So that's telling you once you get rid of all the noise associated with reopening from Winsor Rise and the sample of which they're monitoring these inflation dynamics. You take, let's say, an interquartile mean of the second quartile and the third quartile, and this is what you get. You get rid of all the stuff that's still depressed for some reason, and you get rid of all the stuff that's skyrocketing to the top for whatever reason, and you're left with inflation that looks a lot more tame than you're sort of observing on a headline, and certainly observing from a narrative perspective. This is very, very different than the narrative out there on inflation. On slide 53. I say that to say this. One of my favorite things from Seinfeld. I say that to say this. Even if we are proven right on our call for inflation to trend lower throughout the second half of 21, OER, owner's equivalent rent, will keep an elevated floor under those metrics. Owner's equivalent rent has already bottomed. So going back to November, it was obviously right sitting in the seat in November, different seat than this one. Said, hey, owner's equivalent probably going to bottom in February. It bottomed in March. It's going to trend higher, trend a lot higher from that point. And we think that process is really starting to pick up and commence here over the next couple of quarters. What I'm showing in this chart is just the spread at the bottom, the spread between Case-Shiller home price appreciation relative to the owner's equivalent rent. And historically, when you've seen cyclical peaks in that spread, as we currently are, I think we're at an all-time high in that spread currently. Yes, we are. We're just shy of the all-time high. Oh, sorry, we're in the 99th percentile, which data point is bigger than this one. Anyway, it's neither here nor there. Anyway, whenever you see a cyclical peak in this spread, it's always been at the precipice of a meaningful and material adjustment higher in owner's equivalent rent. And obviously, it's fundamental. One, you have prices spilling over into rents. That's obvious. It's the most direct linkage. But two, I think what happens, you price people out of the home purchase market and force them into the rental market. And what's also happening right now is that And I think that's happening in droves right now, because a lot of people are looking around and they sold their existing homes and said, hey, we never thought we were going to get a price for this, so let's just sell it. But now those people, when they sell, they got to go rent somewhere because it's not a good time to buy a new house. They know that. They just took advantage of the market. And so you have a lot of people now renting apartments that used to be homeowners that are actually likely to catalyze an even further or an even faster appreciation of home owners equivalent rent, potentially relative to previous cycles. Again, hard to get to the screws on that. I mean, if you want to get to the screws on that, on slide 54, our model is actually calling for 3 to 3.5% for upside to 3 to 3.5% for shelter CPI over the next 12 months. If you put a gun in my head, I would actually take the red line over the black line and the green line. Again, the red line is the upper boundary of the projections. The green line is the lower boundary. I'd just as soon think owner's equivalent rent, which is, there are 3/4 of shelter CPI. That's, that if that's going to go up meaningfully over the next 12 to 18 months, which obviously is part of this calculation, it's very likely we see some upside surprises in shelter CPI as well. But again, all of this is happening in the context of everything else in this inflation basket decelerating. And so really all that means is that you're going to decelerate not that fast from a headline perspective, but it's still very likely that you're getting disinflationary prints starting in July and really through the middle part of next year. On slide 55, if we're wrong on everything I just said, if inflation continues to surprise to the upside from here, risk assets are doomed. This chart shows the real earnings yield. The blue line is the real earnings yield for the S&P 500. And 5 of the last 6 times this thing went negative. Obviously, it's deeply negative now. It was just ahead of a major drawdown in stocks. So again, I'm not Dr. Doom here. I think asset markets go up over time, particularly when the Fed's easing monetary policy. But certainly, I do believe that inflation, if the market's perception on inflation, which is somewhat contained, obviously, 10-year break-evens are bearish FAMs, 10-year nominals, bearish FAMs. If the market's expectations on inflation, you really start to come unglued again, then we're at a very dangerous part in the market regime cycle, the dominant market regime cycle, to sort of have that happen. And so this is something to keep this chart in mind. On slide 56, the patient, it cannot survive without increasing quantities of medicine. This chart shows the G4 central bank balance sheet relative to world equity market cap. So obviously, those lines are incredibly correlated. We understand why they're incredibly correlated. So this is why the tapering dynamic in the latter part of this year is likely to be something that asset markets have to digest and potentially digest in an uncomfortable manner. On slide 57, looking at leverage. So again, this is one of the four big secular things that matter. When I think about secular, it's okay, stuff that matters for more than a couple of quarters. Like when I say secular, it's like 1 to 3 years forward. Could potentially be longer than that. But again, if you're having discussions with people about 4, 5, 6, 7 years from now, that's really not that. You're not having a risk management discussion. You're having an investment discussion or long-term strategic asset allocation discussion. What we're doing here is trying to help you risk manage, the bare minimum, the next, 6 to 9 months of macro risk. Because we think that's our sweet spot into our bread and butter in terms of getting investors practically prepared in position for that. But obviously we have longer term views that are born out, again, demographics, leverage, politics, and balance of payments, and all the things that fall out of those 4 frameworks. That's how we sort of get there. And so in terms of how we think about leverage, we think about it through the lens of the private non-financial sector credit to GP ratio and through the lens of the private non-financial sector debt service ratio. And as you can see, in line with past cycles, extend and pretend, extend debt and pretend like it's all going to come back, perfectly amortized, was the global policy response to the COVID-19 crisis as well. Well, extend and pretend works only if you don't do what in the slide 58 implies. On slide 58, the Fed has a history of prematurely tightening. And so the blue line shows the Fed's balance sheet relative to the red line, which is the National Financial Conditions, Chicago Fed's Financial Conditions Index. And so, they ended QE1 too early. They ended QE2 too early. They started QT in 2018, and we had Balmageddon, and then we had the Q4 18 sell-off. Like these guys, if you're going to pump a bunch of debt into the economy, you got to keep the game going. And so this is the Fed has a history of this. I think Jay Powell is well aware of this history. And this is why the Fed has been on balance a lot more dovish in this cycle than they historically have been in terms of, allowing for inflation, changing their inflation framework to average inflation targeting, but also allowing inflation to surprise the upside for a few months. But again, if we, it could be all bets are off of July CPI. It looks like it's the start of a trend of materially high inflation prints, of unfettered used car pricing appreciation again. We think all that stuff is peaked and rolling over here. But again, if it doesn't, we could be wrong on that, obviously. And if it doesn't, then this looks like we might be putting another black dotted line on this slide here on slide 58 in short order. On slide 59. So you remember the summer of 2010. So the risk of a similar outcome is not immaterial. This is showing the 16% drawdown that the S&P 500 had in the summer of 2010 when the Fed pulled back the liquidity spigot a little bit too soon, a little bit too early in the recovery. On slide 60, so the overlap between the 2009 and 2010 recovery experience and today's setup is why investor consensus, in my opinion, has been increasingly on edge of late. Like the economic setup and these charts in terms of the analog is perfect. You had a big financial crisis that was, born out of a big economic event to the downside, obviously pandemic versus financial crisis. But again, same setup. We bottomed in March, and the reflation in the bottom up macro regime reflation, i.e. growth and inflation accelerating high, trending higher, really perpetuated a, kind of a very low volatile, very low vol, price appreciation, trending long-term, year-long price appreciation, over a year in both cases, actually. And so the setup is very similar, but now we're getting to the point where, okay, growth is actually starting to inflect lower, right around the same time growth inflected lower than that in that cycle. And to me, this is why you have, you see that the markets priced that in 2010, again, partially because QE1 ended. Well, we still have open-ended QE now, but again, if they start to pull back on the reins and tighten it up a bit, that's when you can actually start to see, the markets really start to behave a little bit more like the analog, like they were for, an extended period of time. So this is something to keep in mind. On slide 61, as it relates to that whole dynamic, the labor market is kind of heating up in an opportune time. This is a chart showing total non-farm payrolls, which are up 8% on a month-on-month annualized basis. Slide 62, hours work are up, almost 9% on a month-on-month annualized basis. Slide 63, wages are up 5.3% on a month-on-month annualized basis, obviously accelerating on a year-over-year basis as well. On 64, wage growth appears increasingly robust as well. So blue line is showing year-over-year average hourly earnings for private sector employees. The red line is showing an FIB, small business job openings hard to fill. That's making a new all-time high there as well. So, it's looking like wages are really starting to move. Now, again, a lot of this wage growth we're seeing, in my opinion, and certainly anecdotally, we can observe is being driven by temporary factors like, hey, here's $50 to sign an application. Well, if you stay here, work McDonald's is like, if you work here for 6 weeks or something like that, it's $500. I mean, this is this stuff is not. Those are temporary things that are associated with having the supply of labor really depressed. And part of the reason the supply of labor is depressed is because you have childcare issues, you have people getting paid $1,200 a month to do nothing, and then you also have COVID. COVID is still out there, and certainly the part of the pockets of the labor market that are unvaccinated are concerned. Again, we're not. We can have a different discussion on whether or not they should get vaccinated, and that's to me, it's a very different discussion for what we're trying to do today. So we'll leave that for a different forum. On slide 65, wage gains have been broad-based. The blue line shows average hourly earnings for blue-collar industries relative to average hourly earnings in the red line for white-collar industries, and obviously making new highs is there. And part of the reason we're seeing broad-based wage gains is we have all-time high labor demand. So the blue line shows the job openings hard to fill at an all-time high. The red line shows JOLTS at an all-time high as well. On slide 67, we still have supply chain disruptions though. So you're seeing the labor force participation rate. It's still down about 3% from where it is, 3 percentage points down. Sorry, not 3 percentage points, 3% from where it was in February of 2020. We're at 61.7% there. So clearly, we, even though we've seen a meaningful labor market recovery since the middle part of last year, we've actually not seen a meaningful recovery in the labor force participation rate. And so that's telling you there's a lot of sort of, what we believe are temporary, but there's something going on that's separate and apart from economic activity that's keeping labor force participation rate depressed. And again, we highlighted those 3 factors just recently. On slide 68, a lot of the supply chain disruptions that are impacting labor supply, they're kind of they're forcing some employers to pay up at least at the bare minimum on a temporary basis for to fulfill job openings. A lot of that disruption stuff has not really impacted earnings right now. It hasn't impacted earnings thus far. We're showing in this chart the Russell 3000 index, the broadest based U.S. equity index, and showing the next 12-month earnings. And we're actually seeing momentum accelerate at the bottom. That's the 4-month rate of change, the percentage change on a 4-month basis. And that's actually accelerating of late. In the context of everything people have been talking about Delta, about Lambda, about Theta, about Zeta, sounds like we're about to go to a Greek party. You haven't seen really any material impact on earnings. And what's more important is on 69, you haven't even seen the impact on earnings for cyclicals. This is the Russell 1000 dynamic index, and you're seeing earnings expectations actually accelerate to the upside for cyclicals as well. So a lot of the fear mongering we've heard about Delta and everything, and Delta, and again, all this COVID dynamic stuff, like it hasn't really impacted earnings. And so the fact that it hasn't really impacted earnings means a lot of the supply chain dynamics haven't really impacted corporations as much as they've impacted labor. On slide 70, we kind of unpack that last point. Thus far, the impact of supply chain disruptions has been mostly felt via rising inflation as opposed to slowing growth. But slowing growth is an emergent risk. And we're showing auto sales, which I believe in the month of July contracted at a 39% annualized rate. That's pretty meaningful, like that. That is pretty meaningful. So we need to be aware that, okay, at some point, we're going to go from supply chain disruption just perpetuating all this inflation because there's more demand than supply, to the fact that we lose a lot of demand just has to be cyclically decelerated in the economy, and you actually have growth slow because again, that supply is the fodder for productivity and for economic activity. And so if supply doesn't return, at least that's when you start to create an air pocket in the economy from a growth perspective. So you're already seeing that in auto sales on slide 71. We're seeing that in new home sales as well. Like you just can't find a builder. You can't find supplies. The lumber's been cut in half, more than cut in half. So they can probably go buy as much lumber as they want now. But it's really started to impact the rate of new home sales. We're actually contracted minus 56% on an annualized basis in the most recent month. On slide 72. So at what point does corporate America transition from seeing elevated labor supply as a tailwind for future revenues to a headwind for margins? Right. At some point, if you're saying, hey, look, hey, we've take a step back. If you're a corporation, thus far, you've been able to just pass on price increases and say, hey, we're not going to do anything about this depressed supply. We're just going to take advantage of all this demand. Well, what happens when all this demand starts to dissipate as a function of, rolling off of federal benefits in general? I'll just use a big, broad B, capital B, big Biden bucks. Once all those big Biden bucks start to roll off, we've obviously seen, the checks diminish. You're likely to see the enhanced unemployment insurance diminish as well. Once that money starts to roll off, then the depressed supply, you don't have this big wave of demand sitting in front of you. So you actually do need to actually start to invest in supply again to grow to grow revenue. But at what point are you is that incremental investment in supply a headwind for the margin? So that's the point I'm raising with this chart here. On slide 73, Dr. Cosby knows best. And so I'm showing the black line, the Korea's Manufacturing Business Survey Index, relative to the blue line, the ISM Manufacturing PMI. The red line is the JP Morgan Global Manufacturing PMI, and those are likely headed lower. They're likely to follow the black line lower. And so with the black line, that 92, that's a data point for August. Obviously, we've only gotten July data for the other two indices. On slide 74, the uptrend in global manufacturing PMIs appears increasingly at risk. So like if I showed you this chart 2 months ago, every dot would be up there in that top right box, maybe with the exception of India, but they're all starting to sag now, and you're starting to see some pretty meaningful economies dip below the line, which is indicative of a decelerating trend. Same thing with services PMI. They're likely to follow their manufacturing counterparts lower on a 2 to 3 month lag. On slide 75. So what does all this mean? Everything I just kind of highlighted. It summarizes U.S. economic surprises are likely to be persistently negative throughout the second half of this year, and earnings may actually start to disappoint as well if we start to see that feedback loop in terms of tighter, paying up for supply and reduction in margins. And then lastly, on slide 76, especially so that it's very easy to surprise to the downside from an economic growth perspective when you have elevated growth rates that are unlikely to be revised down by a meaningful degree. So unless we get like a real actual COVID event, it's very unlikely that these growth expectations are going to be revised down by a meaningful degree, partially for two reasons. One, the economy is unlikely to decelerate that quickly in accordance with our projections, but more also, you still have $550 billion of infrastructure on the tape, on the debate tape, and you have $3.5 trillion of the capital B, big Biden bucks, on the debate tape as well down in DC. So until we get some meaningful resolution there, it's unlikely we see growth expectations revised down sharply one way or another, revised up or down. On slide 77. So again, one of the four key secular forces that we really care about is politics. The drivers of populism suggest the U.S. has become an emerging market from a political risk perspective. So that's a shot across the bow for us folks in America. So the x-axis is showing the Gini coefficient. That's a measure of income dispersion. Higher is more unequal. And then the y-axis is the headline unemployment rate. As you can see, our compadres, our amigos surrounding us, our emerging markets, not places like Russia, China, Chile, Mexico. It's not Germany, Japan, France. That's what you would expect to see with a major superpower. One of the world leading economies. That's not the case. And in my opinion, this is what's perpetuating the zeitgeist that you're seeing out there. The U.S. is the same amount of political risk that most emerging market economies have now, and there's no way you can tell me otherwise. If we saw what we saw last summer, and then you saw what we saw in January down in D.C., I would argue we were very much fulfilling the key takeaway from this slide. On slide 78, I said this a lot of times. This is the most important chart of macro, and the most important chart of macro proves why inflationary populism has bipartisan support in the U.S. And the blue line shows the compensation of employees as a percent of national income. The red line shows the corporate profits as a percent of national income. And as you can see, those lines have meaningfully transposed over the last couple of decades. You've got globalization, you've got automation, you've got the growth of private equity and industry concentration, the development of monopsonies as a function of corporations being able to effectively capitalize moats with debt. You've got all these different dynamics that have really contributed to a real breakdown in what had been the social contract in America. There's a very stable relationship for many decades, and obviously it's really broken down and catalyzed a lot of political instability here in the U.S. So this is why you're seeing bipartisan support for populism. Mitch McConnell's not arguing if it's 1.5 trillion versus 2.5 trillion. He's arguing if it's going to be, 2.8 trillion versus 2.5 trillion. We're talking about persistent trillion-dollar budget deficits going forward. Trump proved that the Republicans are okay with that, and so much that Biden is proving that the Democrats are increasingly okay with that as well. And that's something that's going to be with us for an extended period of time, again, as a function of the zeitgeist, that again is a function of where we are from an income and inequality perspective, where we are from the perspective of the cyclical degradation, that we've observed in our labor market. On slide 79, balance of payments is again that fourth secular factor. So I would like to marry that up with everything I just said about politics, because again, if populism has bipartisan support now, in a way that it did not prior to the Trump administration, certainly did not in the Rand Paul, that era of U.S. Fiscal policy. The last time the debt ceiling was a real big deal. The real key takeaway of the question is, who is going to be called upon to finance bipartisan populism in the U.S.? Because it means a lot more Treasury issuance, right? And so what we're showing here on the x-axis, the current account balance as percent of GDP. The y-axis is the sovereign fiscal balance as percent of GDP. And we obviously have a problem. We can't finance it ourselves. We have a net national savings deficit. So somebody's got to plug that hole. Is it going to be foreign investors, or are going to be, who knows? Let's find out. On slide 80, foreign central banks have eschewed dollar recycling since 2015. This line shows international reserve assets as a percent of U.S. public debt outstanding. And so they don't want our money. Well, so it means on slide 81, that implies the Fed will be increasingly called upon to finance bloated budget deficits throughout the remainder of this fourth turning, with all deference and respect to my former colleague, Neil Howe. The Fed's got to keep this game going, because if they don't do it, we obviously know the foreigners aren't going to do it. The only way the foreigners are going to do it if you hike short-term interest rates and give them a return of their capital for the reserve assets. They're not going to do that. Fed's obviously not going to do that either, to blow up the U.S. economy. Look, you guys have to be the ones to finance this stuff. So that's a key. That's something to keep in mind long term, because on slide 82, the real key question is, will the Fed be a willing participant in all that, or will they be dragged along by intermittent material corrections in risk assets that say, hey, turn back on the QE spigot, man. We got to finance this Treasury Department. Now, if they're not proactive about that, we're going to see some stop-start action in both the economy and asset markets. So that's something to keep in mind as well in terms of the Fed, the Treasury's projected budget issuance calendar, and really not only just from a cyclical perspective, but from a long-term perspective as well. These guys are going to be gobbling up a lot of your money, or at the bare minimum, they're going to be gobbling up a lot of the Fed money. If it's gobbling up a lot of your money, guess what? We're going to have a lot more volatility in asset markets over the long term. On slide 83. Declining terminal Fed funds rate expectations suggest the latter catalyst is a higher probability outcome at the current juncture. And what I mean by that is, when the Fed said, hey, we're going to hike the dot plot in June, it was a signal to investors that, hey, we're not going to be this, pro MMT central bank that you might have thought we were, with the advent of the average inflation targeting regime and with the advent of the maximum and inclusive employment goal. So if they're not going to do that, it's a signal that, hey, nominal GDP's got to come down. So we've seen that reflected in the long end. Inflation expectations got to come down. We've seen that reflected in break evens as well. And ultimately, it's a signal that, hey, when the Treasury Department starts to actually turn that debt spigot back on in Q4, and if we're talking about tapering and actually tapering in that time frame, we can actually see what I mean by, hey, the Treasury Department, which sits at the top of the global capital structure, is going to start to suck liquidity out of the rest of the asset markets to capitalize itself. The Fed's either got to pay for it, foreigners got to pay for it, or you got to pay for it. If the Fed's not paying for it, we know foreigners aren't going to pay for it. Guess who has to pay for all that debt issuance? We do, which means we got to sell stuff to buy it. That's the key takeaway. All right, on slide 84, asset markets got ahead of themselves in pricing in the secular regime shift to a weak dollar / higher nominal GDP environment. So what we're showing here in this chart is the red line is the broad trade weighted dollar index relative to the Russell 1000 defensive index as a ratio to the Russell 1000 dynamic index, which is cyclicals versus defensives. Obviously, it was a straight line down in that blue line, that ratio really through the early part of this year. But obviously, since the dollar has failed to make new lows, and obviously we touched on this earlier in the presentation, it's persistently and maddeningly neutral BAM state has obviously catalyzed a recovery in the blue line. Again, I do believe we are transitioning to a longer term dollar bear market. However, that transition, as I laid out on Macro Voices a few weeks ago, is unlikely to be linear. There's obviously going to be, and we're obviously observing a very non-linear move with respect to the underperformance of cyclicals relative to defensives over the past a couple of months. On slide 85 here. So that is why, in my opinion, going back to the Fed, the hawkish dot plot revision, that hawkish dot plot revision sent a bearish signal into asset markets from the perspective of long-term nominal GDP growth expectations. And from my perspective, that is why commodities have been consolidating for nearly 2 months now, basically going sideways on the CRB index. On slide 86, ultimately the dollar will determine whether or not commodities can break out of their multi-month consolidation and form new highs. This we know the dollar is, historically speaking, the dollars and commodities have been very, inversely correlated. And so to the extent that we see, further appreciation of the dollar from here, it's very unlikely we're going to see commodities break out of that consolidation and form new highs. But so obviously we probably do need to see some dollar weakness from here to get that to occur. On slide 87, kind of looking at this from a fundamental lens, China's credit impulse continues to trend lower, which reduces the probability commodities unconsolidate meaningfully higher. I'm not even sure if that's a word. Obviously, isn't if I had to hyphenate it. But again, so the Chinese credit impulse is denoted by the red and blue lines in this chart, continue to trend lower. And historically, they've been leading indicators for commodities. Again, you don't necessarily need to be worried about commodities when the Chinese credit impulse is peaking, but certainly, a couple of quarters into the deceleration, that's usually when it starts to feed over into asset markets. On slide 88, the liquidity dynamics on the mainland suggest China's credit impulse is unlikely to inflect meaningfully higher anytime soon. So what we're showing here is SHIBOR, 3-month SHIBOR, which I'd like to think is the most relevant proxy for Chinese financial conditions out there. 80+% of interbank, 80+% of private non-financial sector credit on the mainland is on a bank balance sheet. So if you can track interbank lending rates, you pretty much know how liquidity is flowing in the Chinese economy. And so, what you've seen in this chart here is that, ahead of the major accelerations of the Chinese credit impulse of the past, sort of in the post-crisis era, or really even during the crisis, you've seen a material and sharp decline in 3-month SHIBOR. And what that material and sharp decline is obviously indicative of is a very aggressive monetary easing policy out of the PBOC. Either they're cutting reserve requirement ratios really sharply. The amount of liquidity they're providing through open market operations or medium-term lending, those are obviously accelerating meaningfully. So clearly, what we're observing now is nothing of the like. We're seeing 3-month SHIBOR trend lower, so it means on balance the Chinese monetary policy is net easy. It's easing. However, it's not easing at the rate that's going to catalyze, at least relative to this historical relationship, a meaningful and trending acceleration in the Chinese credit impulse in the near term. So that's something to keep in mind as well as the commodities. Again, our grid model has the Chinese economy actually accelerating to the downside in growth terms over the next couple of months. On slide 89, commodities are also seasonally weak throughout the second half of the year. This is something to keep in mind. Again, not a huge fan of seasonality, but I do believe it can be relevant as a tertiary read in terms of your risk management thought processes. On slide 90, this we know. Investors have a near record amounts of cash on hand. And so they're showing the ICI money market fund assets. And it's not just investors. Now you got corporations, you have mutual funds. So there's a lot of cash out there sloshing around on the sidelines. And on slide 91, where we show, this is data from DataTrek that shows, retail investors have about $400 billion in dry powder. And on a big buy the dip down day, we're talking about like $2 to $3 billion of that being used. So there's a lot of money that, sitting out there that could potentially chase assets. Now, again, I made the case that maybe commodities, again, I'm not saying anything is possible, just in the context of what we have projected from the economic standpoint, and then ultimately what we have currently nowcasted from a dominant market regime standpoint. I just don't see a tremendous amount of upside from here in the near term, over the next month or two in terms of commodities. But again, could be totally wrong in that. It would be, certainly bucking the trend, and it would likely, you would need to see a move towards a broadening Goldilocks or potentially reflation. Although again, I don't believe reflation is a meaningful. Should be part of the discussion at this point. The probability for both a market regime perspective and also the conditional probability from a bottom up macro regime perspective on reflation is saying, okay, that is a rearview mirror event. Looking at slide 92, in terms of what could all that money could chase, and I would argue it's arguably chased it to some degree already. Bonds are seasonally strong throughout the summer and early fall, and they actually benefit from an aggressive repricing and tapering expectation. So let me walk you through what I mean by that. Is if the Federal Reserve starts to taper, and particularly as they taper in the latter part of Q3 and in really early part of Q4, assuming we'll be on the other side of the debt ceiling by then. Again, that's a huge assumption, just given the tea leaves coming out of DC of late. But let's assume we're there, and they're tapering into a rise in Treasury issuance. That's likely to tighten financial conditions in a way that might be quite positive for perceived safety assets like treasuries, like gold, like the US dollar, your classic deflation type market action. So again, not betting on any of this, but we're certainly saying that's a possibility, just given the likelihood that, once we do finally see the Fed start to, drain liquidity from the system at the margins, we could actually start to see more traditional, quote unquote, deflation market action. But again, we have a thoughtful, balanced, carefully constructed portfolio as identified on slides 93 and 94, just reviewing our dynamic asset allocation framework, as well as our portfolio construction process, and ultimately arriving at slide 95, which again is our current portfolio construction. It's thoughtful, it's balanced. We're not trying to lean all one way or all in the other way. We want to take advantage of how we see the cards unfolding from a dominant market regime perspective in the context of what we have projected from a bottom-up macro regime perspective. Kind of getting into, why some of the exposures are on that slide 95, why are they in that portfolio construction? As you know, we take our grid asset market back test, and we're really trying to identify, through four distinct lenses, how asset markets are likely to behave in the context of what we have projected for the economy. And so on the x-axis, we're showing our mean volatility and covariance ranking as a proxy for risk. And on the y-axis, we're showing our mean expected return, expected annualized return, and percent positive ratio rankings on the y-axis as a proxy for reward. So as when you're looking at these charts, what you want to do is identify things that are at the top left. Those are your long ideas. Those are things you want to look at from a quantitative lens or the bare minimum technical lens to say, hey, these are the kinds of things I can buy the dips in. Whereas in so much that things towards the bottom right, those are the things that on balance you tend to want to be selling rips in. Because they have a high risk, low amount of reward. Slide 97, looking at our global equities backtest summary. Slide 98 is our commodities. Slide 99, fixed income. Slide 100, FX. And then we dump it all in one chart. So the x-axis on slide 101 we're taking the y-axis of the previous, or dividing the x-axis from the previous charts with the y-axis from the previous charts, and then we're showing on the y-axis just ranking the annualized expected returns from each of those back tests. And then lastly on slide 102, we have our portfolio construction candidates, which are just winterizing the previous chart to the upper median from a annualized expected return ranking perspective. So kind of just zeroing in on things you should be pushing through the risk management pipe. So how our process works is, okay, we look at the things that are closest to the top left of these scatter plots, and then we push them through the lens of our volatility adjusted momentum signal. Okay. Now the back test is saying this should work, and the volatility adjusted momentum signal saying it is, the bare minimum neutral, but likely bullish if we're adding it. Then that's something we like. that's something you can invest in, and that's something that's being supported by both real-time market information, i.e. what's the local price, local volatility regime, and relative to the medium-term price and volatility regimes, but it's also being supported by 25 years of back-tested data with respect to the economy, asset markets, and policy. I think it's a pretty robust process. At the bare minimum, it's more thoughtful than just saying, hey, I think inflation is going up, therefore I got to go buy this, or I think inflation is going down, therefore I got to buy that. I think that's a good starting point. It's I think up and down implies rate of change. So if you're using that kind of framework, it's better than I guess the alternative. But certainly we want to be as thoughtful and balanced as we possibly can be. And then lastly, I don't want to get into all these because again, you guys can sort of go through the deck on your own. I just put all this information in the appendix here for you to review. But just in terms of how to read these tables on slide 103. So what we're trying to do is, again, these are the tables that feed 103's annualized expected returns for U.S. equities, 104's percent positive ratios, 105 is volatility, and 106 is covariance. These are the tables that are feeding into those scatter plots. And what the column on the far right are the rankings that are feeding into those scatter plots. And so in terms of how to read these tables, when you look at each column is its own independent back test within the context of the broader bottom-up macro regime that we have selected. So clearly we have deselected for macro regime. So that's deflation, that's growth and inflation slowing simultaneously. That's what we have projected starting in September through the balance of the first quarter of next year. So we want to be cognizant of, identifying ex ante securities that are likely, or exposures rather, that are likely to outperform in that environment. And so, just for example, in terms of how to read this, the S&P 500 had a minus 2% annualized expected return when you're in deflation, in months when you're in deflation. So that's obviously nothing to write home about in risk management terms, but it's certainly negative, and it's definitely not extremely positive like you would be in Goldilocks or reflation. But when you're in deflation, but you're only slowing at a modest pace from a growth and inflation perspective, those have historically been quite positive. If you look at the plus 11.5% annualized expected return for 0 sigma delta on growth, and a plus 6.5% annualized expected return for the S&P 500 on a 0 sigma delta on inflation. We don't have any expectations for any policy rate changes anytime soon. Likely won't until at least the second half of next year, or probably early part of the 2023. So that column will likely remain blank for an extended period of time. Balance sheet, clearly we are on the precipice of a tightening of monetary policy. Now, what month that occurs in is the only thing that the month that occurs in really matters for is, okay, can Goldilocks return, for, let's call it 4 to 6 to 8 weeks as a dominant market regime in between now and the end of the year when the Fed finally does make the tapering pivot. If they make it sooner than that, then it reduces the probability that you could have, a broadening sort of Goldilocks type move in asset markets. Fiscal policy still tightening, and likely will be tightening, irrespective of what happens with the budget resolution, with the continuing resolution, with the debt ceiling, with all the stuff associated therein. We're going to be tightening fiscal policy for an extended period of time, because the fiscal impulse relative to 2021, particularly relative from fiscal 21 to fiscal 22, is going to be dramatically negative. And now it'll be in the context of a dramatically improved economy. So the ultimate economic impact won't be that big, but it'll definitely be a tightening. So we want to program that information into the back test as well. And then lastly, what's the rest of the world doing in the context of the US being in D? So of informing the back test, okay, put in this sample, all the times where both the US and the world were in bottom-up macro regime deflation simultaneously, and what's that annualized expected return, percent positive ratio, volatility, and covariance. So we're doing that across all 5 asset classes, US equities, all 5 major liquid asset classes, US equities, global equities, commodities, fixed income, and FX. And then jumping ahead to slide 123, we're showing our grid asset market backtest data at the individual exposure level. Looking again, annualized expected return, percentile of expected returns, in size, percent positive ratio, volatility, and covariance. We're doing this across the major asset classes. And then starting on slide 129, all the way through the end of the presentation on 148, we're showing each of the grid asset market backtests for each of the exposures currently in our portfolio construction. So with that, we'll wrap up our August macro scouting report. I appreciate you guys taking the time to sit with me through this. I know it's a lot of data coming at you. I know we're going to continue to learn and evolve over time. And I'm grateful for the opportunity to do that alongside each of you. So thank you. God bless. And I'll catch you back here next month. Cheers.